The housing market and our house prices are our national pastime. It is to us what soccer is to the Brazilians and what tea is to the English. High house prices themselves are not a bad thing. It's the ratio to income that is the problem. It wouldn't matter if the average house price was, say, $10 million if we're all earning $5 million a year. So currently, Australia has one of the highest house price to income ratios in the world, and it has been rapidly growing over the last few years. It's that ratio that's strangling Australia's future growth prospects. It impacts how people live, how they spend, and increasingly how the economy functions. In this video, I'll look at 3 outcomes of this ratio and how it will shape the future of our economy. The first is a higher debt burden, which means lower economic freedom. So housing is absorbing a growing share of household income, particularly among young people. Ironically, CBA, which is the largest home lender in Australia, advised that only 30% of your income should go towards mortgage repayments. But the statistics show that the mortgage repayments are now approaching 50% of household income on average, and this is starting to show up in broader economic outcomes. In an article by the economics editor of the Australian Financial Review, he notes that housing is contributing to stagnating living standards and sluggish real incomes, with rising housing costs effectively offsetting income growth. In the article, he quotes the chief of Australian Super. So what we've done is just poured all this money into houses and then sold it on to someone, which has deprived the economy of heaps and heaps of productive capital. We've got all this money in our domestic houses and we're not backing business. We're not creating new things. We're not driving productivity. In the article, he also notes that in the United States, the total housing stock is worth less than twice the size of its economy. In Australia, the value of the housing stock is 4 times as large as the economy. It's not just that housing is expensive, it's that it is crowding out everything else. As more income is directed towards mortgages and rent, discretionary spending falls, savings capacity declines, financial flexibility is reduced. For instance, people are highly affected by interest rate rises, and that has a second order effects. People are less able to change jobs, they're less able to take risks, and they're less able to start businesses. The second effect is a lower fertility rate, which means delayed or fewer families. So Australia's fertility rate now sits at 1.51 children per woman, well below the 2.1 required to sustain the population. Births remain below pre-COVID levels, with 292,000 births in 2024 compared to 304,000 in 2019, and it's expected to take some time before Australia reaches the 350,000 births per year needed to support long-term economic growth. What is more telling is where those births are occurring. In Sydney, the most expensive housing market in the country, births are down 9.4% since 2019. By contrast, regional areas where housing is more affordable have seen births rise by 2.5% over the same period. The mechanism is relatively simple, and I'm sure we've all seen it amongst our friends and family. Higher house prices delay home ownership, delayed home ownership delays family formation, and delayed family formation results in fewer children over a lifetime. On a long enough timeline, these factors compound and we end up with less working citizens paying tax to look after a lot more older citizens. Demographers call this a population time bomb, and it tends to spiral further out of control without serious intervention. Sure, other countries around the world have similar issues, and it is caused by many things, but that doesn't mean that we shouldn't be working to tackle one of the biggest contributors to it, housing costs. The third effect is less economic dynamism, resulting in fewer businesses. So there is an ongoing shift occurring in who is starting businesses. Only 8% of small business owners in Australia are under 30, while 57% are age 50 plus, with the average age of all business owners continuing to rise. At the same time, home ownership for 25 to 29-year-olds has fallen to 36%, down from around 50% in the 1970s. This matters because property ownership has historically been a key source of collateral for business lending. Without it, younger cohorts face a higher barrier to entry, which means less ability to secure funding, greater reliance on family capital, or a decision not to start at all because of the need to save long-term for a house deposit. Even for those who do enter the market, higher mortgage burdens reduce risk appetite, pushing people towards more stable employment rather than entrepreneurial activity. The result is a shrinking pipeline of new business owners and an aging small business base. That means less innovative new startups, making a less dynamic economy both locally and on the global stage. This table shows economic complexities of economies around the world. The more complex an economy is, the more different things it has going on, which creates a strength and resilience. So to conclude, for town centres and commercial property, this means fewer people with less disposable income supporting fewer local businesses. That is not a good outcome for our town centres or for our broader economy. Many different factors have led to this stage, and there are many levers to be pulled and issues to be tackled, including NIMBYism, zoning, red tape, construction productivity, migration rates, tax settings, stamp duty, foreign ownership, and a whole host of others. Many people support tackling one issue but not the other, primarily due, in my experience, to their own personal circumstances or what they think that their voter base wants. My point is that this is such a big issue that will strangle our country. We should be tackling them all head on for the future of our country. John Howard once said, "No one stopped me in the street and said they were unhappy about the value of their home going up." Well, John, the young people who have to buy those homes after 30 to 40 years of compounding price growth are pretty unhappy about that.